Welcome back to Talk Tickers, the show where we cut through the noise of earnings season and get straight to the signal. Today, we are turning our attention to a ticker that has been quietly undergoing a massive evolution. Renasant Corporation, ticker RNST.
It is good to be here, and you are right about the evolution. I mean, if you have been watching the regional banking space, you know it's a war zone out there.
There really is.
It's January 2026, and everyone is fighting on like three fronts. You've got deposit competition, credit normalization, and this desperate need to prove that scale actually equals profitability.
Exactly. And that is why today's deep dive is so crucial. We're looking at Renasant's Q4 2025 results. And this isn't just a standard quarter for them. This is the proof in the pudding moment. It's coming right after their massive merger with the First, which closed back in April 2025. They've been in integration mode for months, and now investors want to see if the machine actually works.
That is the core question. You do a big deal, you promise synergies, you promise scale, but can you graduate from integration mode to execution mode?
Can you actually print the numbers?
Right, because the market has very, very little patience left for transition years.
Well, let's look at the scoreboard, because Renasant didn't just print the numbers, they seemingly printed money this quarter. Let's hit the results snapshot. Adjusted earnings per share came in at 91 cents.
Which is a significant number because the street was only looking for what, 78 cents?
78. That is a 16% beat, a massive beat in the banking world, where things usually move by pennies.
For sure.
Revenue clocked in at 278.5, $2 million, also ahead of expectations. Now here is where it gets really interesting. If you were watching the tape pre-market, the stock was actually wobbly. It was down slightly.
Yeah, that's the initial skepticism. The algorithm sees the headline beat, but the human traders are waiting. They want to see the margins.
I want to know if it's real.
Exactly. Is this a low-quality beat driven by, one-time items, or is this real operational muscle? It's very easy to manufacture an earnings beat by releasing loan loss reserves, so the market needed to verify the source.
And the market got its answer. By the closing bell, RNST rallied to finish up 3.1% at around $38.35. A very decisive move.
It tells us that the market bought the profitability narrative. And when you dig into the metrics management was shouting from the rooftops, you see why.
Okay, let's get into those.
Adjusted return on assets, or ROA, hit 1.29%. That's up 20 basis points just from last quarter.
And the big one?
And the big one, adjusted return on tangible common equity, ROTCE, jumped to 16.18%.
Wow, that's up nearly 200 basis points.
A huge leap.
Let's just pause on that for a second. Why is ROTCE the magic number here for anyone who doesn't live inside a bank balance sheet?
Think of it as the efficiency of the shareholder's actual cash. It strips out intangible stuff like goodwill. A 16% return means for every dollar of tangible equity investors have in the bank, Renasant generated 16 cents of profit.
And in the regional banking world,
anything over 15% is generally considered the threshold for, high-quality investable banks. So jumping 200 basis points in a single quarter is a massive step change. It signals they aren't just bigger, they are actually better.
So what does this all mean for you, the listener? It means the operating leverage from the merger is finally kicking in. This isn't just accounting. This is the efficiency engine roaring to life.
It's the difference between buying a bigger car and actually driving it fast. For the last 9 months, Renasant has been in the garage, tuning the engine. Now they're on the highway.
Okay, let's unpack that garage phase, because the core theme of this call was that 2025 was a transformative year. Management made a huge deal about finishing the systems conversion in Q3.
I cannot overstate how important that is. Systems conversions are where bank mergers usually go to die.
Or at least where they get incredibly expensive.
And frustrating. You have angry customers, you have staff quitting because they hate the new software. It's a total nightmare.
It's the technological equivalent of a root canal.
Exactly. And Renasant is saying we are done with that. With the conversion in the rearview mirror, the synergy capture can actually happen. You can't fully cut costs if you're still running 2 parallel systems.
And speaking of efficiency work, let's talk about expense discipline. That is the polite corporate term they use.
Right.
I'm going to use the plainer term, cost cutting. And it looks pretty ruthless.
It is significant. We are not talking about trimming the coffee budget here.
Kevin Chapman, the CEO, he dropped a stat that made my eyebrows go up. He noted that in June 2024, the combined employee count of the two banks was over 3,400.
Okay.
By the end of 2025, they're sub 3,000.
Wow. That is 400 positions, over 10% of the workforce gone in 18 months. That is a massive reduction.
And management was clear this wasn't just merger synergies, they called them accountability actions. They explicitly mentioned exiting underperforming producers.
This is a crucial distinction. Usually you just cut the back office, HR, IT, that kind of thing. But Renasant is doing something more aggressive. They're looking at the front line, the loan officers, and saying, if you aren't hitting your numbers, you are out.
That sounds intense, but they also said they're hiring new people.
You're right, and that is the push-pull strategy. It's about upgrading talent density. You fire the bottom 10% to lower your cost base, and then you use some of those savings to hire a superstar who can bring in more business. It's a difficult needle to thread, but the numbers suggest they're doing it.
And they guided for another $2 to $3 million in core expense reductions in Q1. The efficiency ratio is already down around 57.5%.
Which is getting into very respectable territory. I mean, an efficiency ratio in the mid-50s is where you want to be. It shows the scale from the merger is really working.
Let's shift gears to the balance sheet, because you can cut your way to profitability for a while, but eventually you have to grow. Loan growth was up 4% annualized in Q4.
Which is solid given the environment. It's not a booming economy.
But there was a headwind. Management has been predicting high loan payoffs all year. For 10 months, they were wrong, and then boom, in Q4, they finally showed up.
Payoffs are a double-edged sword. You're losing earning assets, which isn't great. But on the other hand, in this environment, getting cash back isn't the worst thing. The fact that they still grew loans net of those payoffs is a sign of strong production.
There was also a specific transaction that distorted the numbers slightly. They sold a $17 million portfolio of loans.
Yeah, these were loans secured by the cash surrender value of life insurance. It's very low risk, but also low yield. Kind of boring.
It came from the first acquisition, and Renasant deemed it non-core because there were no ancillary relationship opportunities.
And this is the discipline of relationship banking. They don't just want to lend you money. They want your checking account, your wealth management, everything. These loans were just transactional, so they sold them. It's a quality over quantity decision.
But let's talk about credit quality. Everyone's terrified of the credit shoe dropping. How did RNST look?
Surprisingly clean. Net charge-offs were $9.1 million. But, and this is important, $2.5 million of that was just an accounting hit tied to that loan sale.
So operational charge-offs were quite low.
Very low. And their allowance for credit losses, the rainy day fund, is sitting at a healthy 1.54% of loans.
Okay.
Management actually admitted something interesting here. They said they're holding higher reserves out of an abundance of caution, and that this caution is actually weighing on their ROA.
Right, because provisioning for loan losses acts as an expense. It drags down the profit number.
Exactly. If they had released those reserves, their earnings would have been even higher. The fact that they beat by 16% while still being conservative tells you how strong the core performance was.
Now let's look at the capital levers. They are making money. What are they doing with it? Their CET1 ratio is strong at around 11.25%.
Which is well above regulatory minimums. They have excess capital.
They were very clear about what they want to do with it. Buybacks.
This is the preferred lever right now. Management signaled they want to keep capital ratios flat, which means they have to send the excess earnings out the door. Buying back stock is the most tax-efficient way to do that when you think your stock is undervalued.
But here's the curveball. Despite just finishing this massive headache-inducing merger, management said M&A is still on the table.
That is a very confident signal. Usually after a deal this size, a bank goes into a shell for a couple of years. They're exhausted. For Renasant to say, hey, we're still looking, implies they feel their integration process is a repeatable machine. They're not tired, they're hungry.
Let's pivot to the investor context. We have the numbers, we have the efficiency story. So what? What's the outlook for 2026?
The guidance is steady. They're looking for mid-single-digit loan growth, a stable net interest margin, and modest net interest income growth. It's not explosive, but it's constructive.
But there was a moment in the call that I found really telling. A moment of candid reflection from CEO Kevin Chapman.
I know exactly the moment you're talking about. It felt unscripted.
He noted that 18 months ago, the metrics they just reported would have placed them in the top quartile of their peer group, best of the best. But because the entire peer group improved, Renasant is currently just middle of the pack.
This is the Red Queen effect. You have to run as fast as you can just to stay in the same place. The whole banking sector got more efficient.
And Chapman sounded bothered by it, like he took it personally.
It's the psychological driver for the stock. Management is not satisfied. They are chasing a moving target. He basically said, we are not dropping a mission accomplished banner yet. This suggests they'll remain aggressive on efficiency.
There is also a hidden catalyst that could help them get there: repricing.
Ah, the earnings torque.
Roughly $1.3 billion in fixed-rate loans are rolling over soon. These loans are currently on the books yielding about 5.25%.
Which is significantly below current market rates.
Right. And new loans are coming on in the high fives or low sixes.
This is simple math, but it's powerful. You have a chunk of your asset base that's about to automatically earn more money. Even if the Fed cuts rates a couple times this year, this repricing wave acts as a natural hedge. It protects their margin.
Speaking of cost, that is the main risk, right? The deposit costs. They called it a dogfight.
It is. It's the main vulnerability. If they have to pay up for deposits to keep customers from fleeing to treasuries, that crushes the margin. That's why the efficiency cuts are so vital. They provide a buffer against that pressure.
So we have a bank that has cut costs, integrated a massive merger, cleaned up its credit, and is angry about being average. That feels like a setup.
It is certainly a setup with potential. It's a coiled spring.
Which brings us to our favorite segment of the show.
Here we go.
The This Is Not Financial Advice segment. And please remember, we are just two voices in your headphones. Do your own diligence. This is just for fun.
What's the pitch today?
I call this one the ruthless efficiency loan.
Okay, I'm listening.
The setup is this. Renasant just proved they can cut 10% of their staff, integrate a huge merger, and still grow. But the market is still pricing them like a generic regional bank because of macro fears.
They're trading in the pack.
Exactly. But we just heard Kevin Chapman express what I am calling a Napoleonic complex about his peer ranking. He hates being in the middle. He's authorized buybacks. He's firing underperformers.
He's motivated. He has something to prove.
So the trade is this. You go leveraged long RNST, and you pair it by shorting a basket of bloated regionals. Specifically, banks with efficiency ratios over 65% who haven't done a deal recently.
So you're betting on the spread between the fit and the fat.
You got it. You're betting on the internal self-help story. The systems conversion alpha means Renasant's costs drop just as their loans reprice higher. It's a double engine boost. The bloated banks, they don't have that lever to pull. If things get tough, the efficient banks survive. The bloated banks get crushed.
It's a play on execution capability. You're saying that in a flat rate environment, the only way to win is to be leaner than the guy next to you. It's outrageous, but the logic holds up if you believe Chapman keeps cutting.
That's the bet. You're betting on the management team's hunger.
And their ability to execute without breaking the culture. That's the hard part.
So let's wrap this up. Renasant delivered a clean beat. 91 cents versus 78 expected. The merger integration is largely done. Expenses are dropping. They're buying back stock.
And don't forget the capital position. They have the dry powder to do more deals or buy back more stock if the price dips.
What's the one thing listeners should watch for in Q1?
Watch the payoffs wild card. Management was conservative on loan growth because they're worried about payoff staying high. If those slow down, Renasant's mid-single-digit growth guidance could prove very conservative. That could lead to another beat on the top line.
There you have it. The efficiency engine is roaring, the systems are converted, and the CEO is looking to climb the rankings. Keep an eye on RNST, check your own charts, do your own work. We will see you on the next tick.